Hey everyone, welcome back. This week was a choppy ride for investors. 3 straight days of selling before stocks finally caught a bounce on Friday. Let's break down what drove the action, the big macro headlines, and where sentiment stands as we head into October. So, what was behind the selling pressure? A few key things. First, stronger than expected economic data. Q2, GDP was revised higher to 3.8%, and jobless claims came in way below expectations. Good news for the economy, but it makes the Fed less likely to move quickly on rate cuts. Second, new tariffs. The White House rolled out sweeping import duties, 100% on branded drugs, 50% on furniture, and 25% on heavy trucks. That rattled tariff-sensitive sectors and raised fresh concerns about profit margins. And then there was Powell. Early in the week, he pointed to a darkening economic picture and warned that stocks look fairly highly valued. That hit sentiment right out of the gate. Now, the big macro print, the August PCE inflation report, the Fed's preferred gauge. Headline PCE rose 0.3% month over month and 2.7% year over year. Core PCE held steady at 2.9%. In short, right in line with expectations. Not hot, not cool, but still sticky at just under 3%. The backdrop here is still strong consumer spending, which helped power that 3.8% GDP growth in Q2. That's resilience, even with higher borrowing costs, and it's what's keeping recession fears in check for now. So, what about sentiment? Positioning is still crowded in AI and mega-cap tech. Those names saw inflows, but also quick reversals when macro headlines hit. On the flip side, defensives and value stocks held up better. The good news? Investors still have plenty of cash parked in money markets, and flows show they're willing to buy dips. Even though stocks pulled back, U.S. equity funds saw about $12 billion of inflows this week and nearly $30 billion globally. That tells you there's no panic, just some repositioning. By Friday, the S&P 500, Dow, and Nasdaq all snapped their losing streaks with a solid rebound. Still, the week ended in the red. Looking ahead, markets are pricing in an 85% chance of a 25 basis point cut at the Fed's October meeting. But with core inflation still close to 3%, the PCE numbers reinforce the idea that the Fed will cut cautiously, not aggressively. So, bottom line, this week was about recalibrating expectations. Growth is holding up, inflation is sticky, and the Fed is keeping markets on edge. As we head into October, investors will be watching every data point and every Fed comment for signs of what comes next. Alright, moving on. Let's explore stocks that are setting up well for bullish plays this week. We'll break down the setups, key levels to watch, and what's making these names stand out for bulls. ALTS has been busy making strategic moves. The company recently closed a $1.5 billion offering to kickstart its World Liberty financial treasury strategy, signaling a strong growth agenda. Leadership updates include the appointment of Jonathan Hu as CFO and the addition of Eric Trump to the board, bringing fresh perspectives at the top. On the innovation side, ALTS integrated the Lightning Network, enabling instant Bitcoin and Tether payments, positioning itself as a leader in digital payment solutions and blockchain adoption, all of which highlight a company focused on growth, strong leadership, and cutting-edge technology. Over the past month, ALTS has been in a downtrend, dropping from around 5.66 in early September to a low near 2.87 just yesterday. That's quite a fall, which tells us sellers have dominated for a while. But here's something interesting. Today we saw a small rebound, with the stock bouncing off that 2.87 level to close at 3.13. That low is starting to act as near-term support, so it could be the floor where buyers step back in. Now, looking at resistance, the stock has some hurdles ahead. The short-term ceiling is around 340 to 3.50 and further up near 3.80, which was tested just a few days ago. So while we might see a bounce, it's likely to face some selling pressure at these levels. Volume tells part of the story too. Friday's volume was lower than the big sell-off days, which could mean selling pressure is easing. But be careful. Low volume bounces are not always reliable. We like to see higher volume on upward moves for a stronger bullish signal. As we all know, ALTS moves closely with the World Liberty Finance token. Lately, the token has been making higher lows, signaling upward momentum. That's a bullish sign. When the token climbs, we can expect ALT5 Sigma to follow suit, riding the same wave of positive momentum. From a technical perspective, this stock looks oversold after its recent drop. If we see it close above 355 to 320 with rising volume, that could signal a short-term bullish reversal or base formation. A short-term bounce is possible, but this is not a confirmed breakout yet. For cautious traders, it may make sense to wait for confirmation or enter a small position with a tight stop just below 227. Now, let's talk about a Fed rate cut sensitive play, UPST. This is a stock that could really benefit if the Federal Reserve moves to lower interest rates. Why? Well, UPST operates in the fintech and lending space, so lower rates generally reduce borrowing costs, spur consumer and business credit demand, and improve loan origination volumes. UPST has been on a bit of a roller coaster. After a strong run into July and early August, we saw a clear pullback through September, with lower highs and lower lows forming, which is a classic sign of short-term weakness. The last few days show some stabilization around the 57 area, but volume is relatively light, suggesting buyers aren't fully committing yet. From a technical perspective, it's not showing a strong bullish setup right now. There's no clear higher low, higher high pattern yet. This could be a period to watch for signs of accumulation or a confirmed reversal before considering a new long position. In short, patience is key here. The stock may need a bit more base building before it's ready for a confident entry. Let's talk about one of the most eye-catching IPOs hitting the market, Fermi, ticker FRMI. This Texas-based REIT is pitching itself as the power source for the AI revolution. The company plans to build massive power plants, natural gas, solar, batteries, and even 4 new nuclear reactors, including what they're calling the Donald Trump generating plant, which would be the largest built in the US in decades. Fermi's vision is huge. By 2038, it aims to generate 11 gigawatts of power, more than 5 times the Hoover Dam, to directly feed energy-hungry AI data centers. The IPO is seeking up to $550 million at a valuation north of $13 billion. But here's the catch. Fermi has low revenue yet, won't generate cash flow until at least 2027, and won't pay dividends for years despite its REIT structure. There are also big execution risks, especially with nuclear projects that historically run massively over budget. That said, the setup is intriguing. The company has a 99-year land lease in Texas, access to pipelines, turbine contracts signed, and financing already underway. By 2029, management projects $3.6 billion in EBITDA, which would make today's valuation look far more reasonable. This IPO is a high-risk, high-reward bet on the AI boom. Near term, it trades on hype, AI plus Trump branding. But long term, execution will determine if this becomes a cornerstone of US energy infrastructure for data centers. And that wraps up this week's market update. I'll be back with more insights next week. Have a fantastic weekend, everyone. Take care.